Hello, and thank you for your interest in my presentation. This will be the first in a series of educational videos that I will be providing, which will all be centered around my educational content. After viewing this video, my goal for you is to gain a better understanding on the importance of top-down technical analysis, identifying market structure, and the path of least resistance while utilizing dynamic tools. Warning: reproduction and sharing of this content is strictly prohibited. All information in this presentation is for educational use only and is not investment advice. There is a substantial risk of loss in trading commodity futures, stocks, options, and foreign exchange products. And of course, past performance is not indicative of future results. In this section, I'll discuss the top-down technical analysis process using the following criteria. First, we'll talk about periodicity hierarchy. Then we'll talk about balanced price behavior, also known as brackets. Then we'll talk about imbalanced price behavior, or also known as one-time framing. Then we'll go into how I look at price channels, and then on to moving averages. Then we'll talk about the volume weighted average price, or VWAP. Then we'll go into looking at market profiles, volume profiles, and also tracking cumulative delta on a larger perspective. Then we'll talk about how I map out support and resistance levels. And lastly, I'll go into drawing out Fibonacci levels, and then of course bringing all this information together. So why top-down analysis? Well, top-down technical analysis provides us a zoomed-out perspective of what the larger time frame money is referencing. It provides us a view of the macro to micro market structure. It helps us identify the path of least resistance on multiple scales and time frames. And we can see clear reaction and structural levels representing trend continuation or a change in trend. And of course, looking at top-down technical analysis from the larger perspective to the smaller perspective is similar to looking at, say, a zoomed-out map and then zooming in to find more details. So, for example, if you're looking to travel somewhere, you would simply look at a larger scale map, and as you zoom in closer, you start to see those details, which would be, say, specific roads or what have you, or specific things that you would use to find your way to your destination. That's essentially what we're doing here. So let's first talk about the periodicity hierarchy that I use. So when looking at the markets, it's incredibly important to assign a filter process to better understand what the larger picture is showing versus what the smaller picture is showing. This will help you understand what the market is attempting to do from a zoomed out to zoomed in perspective, as I just discussed. So the hierarchy I like to assign to my top-down filter process, just from a pure bar chart periodicity, is the following. I first like to look at yearly bars, quarterly bars, monthly bars, weekly bars, and then lastly daily bars. And from time to time I will look at smaller time period or volume-based bars, but for the and I'll show this later in this presentation. But the idea here is to really, again, just look at what the real big picture is showing us and bringing that closer and closer into more detail. So here's an example. This is simply the S&P 500 cash index, but what we're looking at here are yearly bars. So if we look at this here, we can see that we had the big boom that took place into the internet tech bubble. And once that burst, we saw that heavy selling occur in the markets, and the market finally found support here, and it immediately, once that support was given, the market simply marched its way right back up to our previous resistance area. During that time, the market was one time framing higher. So one time framing, one time framing, one time framing, one time framing, really just a big drop here. But essentially, the market is very visual in where the areas that it wants to rotate to. So it comes right back to resistance. We see that we have somewhat of a blow-off candle, and the next year the market really just free falls straight back to our support area. So there was just really nothing in between here. The market just very quickly traveled back to support, The next year the market opened, looked lower, and immediately came right back into our range, and from that point we one time framed right back to our resistance area. However, this time we can see a strong push through that area. So that again is giving us larger picture information. We know what our ranges are, and when we see a bar like this, that just kind of simply tells us that there's something is potentially changed here, and we are making a strong move out of this area. The same thing can be seen on quarterly bars. We can see the market established its swing highs and lows. Once it established the swing low, it immediately marched its way right back up to the highs. But in between that point, we can see how there are periods of one time framing, periods of balance, a breakout of that period, test the top of that balance, one time framing. Well, you can't quite say that, but as we did take out a few lows here, but essentially it was a very strong move higher here, and then as we got to that previous resistance, we do see that one time framing behavior until we got to that resistance high, and we have a strong kind of takeout of the previous low, and a bit of a balance, and then of course one time framing lower, same activity going higher, periods of balance and one time framing. So now we've reached that previous high. Again, we see a very strong bar close at those highs, and the next bar we had a bit of a blow off type candle, but this current quarter, this is actually maybe a quarter or two back, but you know, very strong push through that level, and very powerful price action there. So just based on those two charts I've just shown, what is it telling us? Well, we were clearly trading within a range. The market has simply gone from one extreme to the other. However, this time we've clearly blown right through that previous resistance area. Could it be a case of the market simply accepting higher prices like it accepted lower prices on the previous swing low? Well, that's certainly possible. But as of right now, we see that we have a strong trend in place. More importantly, when looking at these last two charts, do we see there being any potential slowing in this trend? And the answer obviously is no. So let's move forward. Let's take a look at monthly bars. Now we can see on these monthly bars a lot more detail. Again, very strong kind of parabolic move, the internet bubble. Again, still looking at the S&P cash. We make a swing low in a clear bracket area, or so imbalance to balance, and then we go imbalanced again, and we see these periods of imbalance and balance occurring over and over, and then once we get to that previous resistance area, we see a bracket being formed. So the idea there is you know, a balance at those extremes again. Once that broke, we see that we rotate immediately right back to our previous swing low, the other extreme. We look below, but we form somewhat of a bracket here again, and the market breaks back higher. Now this time we can see that there potentially could have been a bracket being formed here. This is a little bit time back, but since that point the market has traded a lot higher than this. So that bracket that was potentially forming did not stay in place. But again, what we're seeing now in the monthly is a lot more detail with the extremes of the balance areas that are occurring. Now we're looking at weekly bars. Same thing. We can see a lot more detail as in terms of identifying those extreme balance areas and the one-time framing behavior. So again, here we were coming back up to that previous resistance area here, and the market did pause for a few weeks, but ultimately, you know, very strong break higher. Then we had a pullback to that previous balance and rejected that, and we were off to higher prices. So now we're really starting to see those details there. And then on the daily bars, this is really where we can actually start to see potential trade locations in addition to other information, of course, but this is really starting to provide us with really good information here. You know, for example, we see the market makes a pullback, tests that previous balance as I'd pointed out on the weekly, a brief pause here, and then we've just really dislocation, all buyers, no sellers anymore, and just one time framing all the way back up to our resistance area. Once we reach that, we do see pause there, but we are seeing more buying coming in and trading higher than that previous swing high there. So the thought there is are we imbalanced or balanced? Well, in this scenario we were balanced. Very, this is very micro, but it is important on a daily level. And we can see that the market's breaking out of that brief balance area at those previous swing highs there. So as you can see, the context in each period provides us with the following. So as I've said before, it provides us with that zoomed out perspective to see the overall market structure. It provides us the ability to take the larger perspective and build it into a smaller time period reference. And of course it provides us with the path of least resistance, in turn giving us a directional bias in terms of intraday or swing trading. So this is all very important information just looking at a plain bar chart. It tells us a lot. But let's start diving a little deeper into some of the items I've discussed, which would be balanced markets and imbalanced markets, also known as bracketing. So what is a balanced market? Well, it's simply context displaying buyers and sellers are in agreement on price. Price is range bound with multiple overlapping price bars. Within that range, we'll see a strong reaction from the buyers at the lows and a strong reaction from the sellers at the highs. And then of course, once price exits that balance or range area, that just tells us that the perception of value has changed. So for example, let's say that going back, the market was, on a yearly bar basis, the market had been trading in a clear range or a bracket, and upon reaching that resistance area this third time, we see a very strong push through that area. That simply just tells us that sellers are no longer interested in selling at those levels, and price discovery is continuing higher. So here's an example of a bracket. So what we see here is we have price bars that are one time framing lower, so we've got a sell side imbalance, and then finally we see the bars begin to overlap each other, and ultimately that one time framing stops. That's always the first heads up that the market is potentially coming into balance. So what do we see here is we establish the high end of that range, and then of course it rotates right back to the low end of that range. The way I draw these brackets out is when I look at the candles themselves, I view the body of the candle as being the acceptance area, with the wicks as being the rejection area. So in this example we see that there was really not much going on at the highs of these bars. It was just very strong, a very strong move lower and lower, and ultimately we see right here in this particular bar that the market takes out the previous high that had not occurred all the way down from this move, and all of a sudden we see that. So we've pulled from the low to the high, and back. Once the market comes back to the low, we can see a reaction there, and again, sellers are interested in these higher prices while buyers are interested in these lower prices. Once we get back to the support area, we see buyers again are stepping in, and this time we see a clean break out of this balance, or a strong close at the highs of this bar, and the market again starts one time framing higher. So from imbalance to balance, back to imbalance. So as I mentioned, the yearly bars was also showing us a very clear balance or bracket area. So again, this is the S&P Cash Index. We're looking at the yearly bars. We established, it was the internet bubble pop, I guess you could say, and the market sold all the way down, and ultimately it found support here. So here's our bracket high, here's our bracket low. And what does the market do? It's a destination move right back to the top of this bracket or this resistance area. Upon confirming resistance, the market comes straight, just 1 year, takes us all the way right back to the low end of this balance or bracket area. Next year looks below and immediately comes right back in and closes inside the bracket. The destination then is to this other resistance area. So it took roughly 3 years to get back to that level. Once we were there, we see that this particular bar paused right below the top of this balance, and then of course the next year we see an opening drive type move and just blows right through that previous resistance. So that's very important information. We know that because this bracket or support area was respected, The destination in this particular example is the expectation to see the market come right back to the previous resistance area. So during this period of time, if you were a longer term trader, your expectation is to see the market come back to this resistance area. I mean, this plays true through multiple time periods, of course, and even on smaller scale perspectives, but it's all the same. It's from one extreme to the other. That's what we're seeing here, and that's what the expectation is. If we look on the quarterly bars, it was essentially the same thing. Our bracket high was here, our bracket low was here. Upon moving higher, the market, as I had explained, how I look at these candles is that it accepted prices slightly higher than the previous time, and then going back to our support area, it accepted prices slightly lower. So what do? We adjust our bracket. However, this time we have a situation where it's a clean breakout of our previous bracket area, and from that point on the market is completely ripped higher. So basically from just about the middle of this balance or bracket area, we've been one time framing higher all the way through our previous resistance area. So again, that tells us that we have a very strong trend in place, and we're now seeing a breakout of that previous range or bracket, and no signs of there being any sort of slowdown in terms of bigger picture structure in this bullish rally that we're seeing here. The monthly bars, as I was explaining earlier, we can see the brackets that are forming at the extremes and these kind of bolder squares I've drawn here. So we've got a bracket high, a bracket low, bracket high, a bracket low. In between there we do have some smaller balance areas that have occurred, and that's what I was discussing earlier, as the market will pause in these balance areas, and once it breaks out it may test the top of that, which is what we saw here. And of course we were just on our way back to our previous resistance. Once the market stalled, we again have two-way trade occurring. Finally sellers take this market out of that previous balance. So from that point on, we immediately come right back to our previous balance, and we pause there. And of course now we see the market somewhat pausing at the previous resistance area or just above it, and has since broken out of that potential bracket that was forming there. So the trend is still in place, and we're continuing to look for higher prices there. Again, looking at the weekly bars, as I had outlined earlier, with these smaller reference balance areas, we can see how the market reacts to those. Each time it rotates between them, there's pause at these extremes, and again, it's just very helpful in watching the day-to-day action to help us with our trade bias and potential trade locations now that we're starting to get into a bit of a smaller time frame perspective. And then the daily bars is, like I said, really where we can start to really zoom in. And so let's just say, for example, in this particular bar, the market was trading at these lows. What direction would you want to be leaning on in terms of being a buyer or a seller? Well, we're at the bottom of this potential big balance area. I'd rather be a buyer at these levels. And of course, if we get stopped out, it means something, and the market's breaking out of that balance area. So in this example here, we see a strong break below that. But in this example here, obviously it worked very well. So the idea then is just simply leaning on these balance extremes is what we need to do. So let's talk about imbalance markets, also known as one time framing, as opposed to balance markets. So what is an imbalance market? An imbalance market is one side of the market is overpowering the other, which is simply results in price discovery. So if there's no sellers at the highs, the market has to keep going higher and higher until it eventually does find those sellers. An easy way to see an imbalance market, of course, is when we see no major overlap of the price bars, or in better terms, one time framing either higher or lower. And when we see that, it's very easy to identify the path of least resistance. So here is an example of a market that was in a balance situation, and then it broke out of that balance. And this is similar to the one I previously shown, is that the market was one time framing lower until finally it took out that previous bar's high. So it was one time framing down, and then once we saw support come in, we saw that high get taken out. And then once the market broke out of that balance, we one time framed higher, and then finally we see that low get taken out. Interestingly enough, that was a previous balance area. We see a balance return to the market, and then finally it starts to auction out of there. So from imbalance here really to balance, imbalance to balance, and then back to imbalance, balance, imbalance. So we just see the rotation from balance to imbalance over and over and over. So again, just to go back to the balance, is when we're in a scenario like this, we obviously want to utilize trade both sides of this area, this balance area. But when we're in a situation like this, we want to continue to try and go with that imbalance or that trend. So here's the weekly bars, same thing, where we see periods of one time framing up, and then we find balance again. We break out of that one time frame lower, that stops. Just kind of indecisive price action. Finally gets to our resistance area. We one time frame for a few weeks, then we find sellers. So you just see it happening over and over, just on a smaller scale, of course. But this definitely helps us with a directional bias. And of course, on the daily bars, that really provides us with our directional bias. So for example, here we have a very strong upward move, one time framing higher. During this period of time, there were 2 days that the market closed down, I guess you could say, from its open. However, they were inside days, essentially, from the previous session. So really, if you were trading the market from the short side, you'd only really have 2 days where it really provided you with much of an opportunity at all. So the point here is that the big days have been the days that have been going with the trend or that imbalance direction. So one time framing higher. And of course here we have just kind of sellers and balance and kind of craziness, and then we do see a strong push lower, and then that one time framing stops. We pause for a while, and then we break out of that balance, and we one time frame higher again. In this particular example, really just no days would have worked for you if you tried to fade that or sell the market short. And then we do see a pause at that previous resistance, but once that stops, I guess you could say, we take out that high there and not the low, and then from that point on we were one time framing higher again. So very difficult to try and fight that type of swimming up that type of river, I guess you could say. And of course we can see the same thing as the daily bars, but also in the form of TPOs. So again, just very strong one time framing, and then we see a pullback really just to this balance area, but a pullback, but then the next day it takes out the high, doesn't take out the low, and then we resume that one time framing higher. So again, very, very hard to try and fade strong upward moves like this. And the same would be the similar situation if you're trying to buy a market that's been in a one-time framing move to the downside. We can also see this on an intraday basis. So in this example here, we have the A period and B period, very strong push higher. C period continues to push higher, and then the D period, we see that it's somewhat of an inside bar, but it can't take out the previous high. And then of course the E period comes in and takes out that low. So, and I'll go into this more in the trade methodology piece, but if you were looking to be a seller or try to get short in the market, better to put that in a better way, you would have a very difficult time trying to trade or to fade this strong move higher. But once we see that the D period could not take out the C period high, and then the E period takes out the low, we see that the F period was obviously a great potential short trade, as well as the K period there. So, and that obviously ran right back to the open. Again, the next day we see some one-time framing. This time it really just did not give you much, and of course it spiked into the close. So when we zoom back, we can see the trend is obviously to the upside. However, Some of the days there were opportunities to the downside, but those ended up being just really just buying opportunities for the larger time frame traders. So just in summary, how do we approach a one time framing market? Well, we want to look to go with the direction of the move, and as I've shown, it's very difficult to go against that strong trend or that move. And of course, we always need to be watching for a change in that pattern. So a stopping in the one time framing, which gives us that heads up that balance is potentially returning back to the markets. So now that we've talked about just the basic price action behavior of the markets, let's start to look at some more details and use some dynamic tools to monitor the price action. So in price channels, I use them. I feel that they're a very valuable tool to understand the bigger picture's context. It provides us with both a support and resistance trend line. It helps us visualize the overall context of the market. And we always want to anchor these channels from key structural changes or fractal points that occur in the market. And then with the channels themselves, I do use a slightly smaller periodicity filter system. So I'll start the highest, I guess you could say, is I'll use the monthly bars, I'll use the weekly bars, the daily bars, and I'll also use some of the smaller time frame references, such as maybe a 240-minute chart. But again, they all need to be from key structural levels and make sense in the larger picture of things. What I mean by that is if you are using a channel that is very micro, say based on an intraday type perspective, the likelihood of that being as powerful as the larger ones is very small. So that's why I feel that it's very important to use the higher time frame references first and foremost in looking at these. So here's an example of most likely I believe this is a monthly bar. I don't have the information on the top there, but just by the looks of the bars themselves, it looks like a monthly bar chart. But more importantly, we can see how the channels are being defined in this example. So we've got the high of the channel being established here. We've got the low, obviously. The market just kind of moved along and it tested the top of that channel, pulled back to the bottom of that channel. This is just kind of the plain viewing of that. But what I have in these lines here are what I would call similar to looking at, say, a bell curve or anything, is that we've got our mean and our standard deviations beyond that mean. So this black line is our mean. The first line above here is our first standard deviation. Then we've got our second, and then we have our third being the outside of that channel. So with knowing that, let's take a look at this in terms of how we would look at, say, market profile or developing value or anything else. We see that the market was establishing its range, I guess you could say, and we established the high. We obviously established the low. Upon finding resistance, the market pulls back into value. So the first standard deviations obviously are our value areas, and the first bar comes down and tests our I guess you could say our point of control or our mean, and the market really just kind of pauses in value for a while, testing the value low for a few months, and then finally we find renewed buying, and we trade back above, and we kind of pause at the value high, and ultimately we break out higher. And where do we rotate to? We rotate right back to those extremes again. We just kind of the second standard deviation becomes support for a period of time, and then we finally have a pullback to the top of value, pause. You can see how, just again, talking about the one time framing, we can see how this starts to come into the picture here a little better. So we see that one time framing stopped here. We test resistance again, and we confirm the selling, and we ultimately we test the top of value, as I said, test the second standard deviation, and close around the top of value once again, and then the next bar or the next month here comes right back into value, and really just goes to the other extreme there and tests the bottom of that. And of course that is pretty strong monthly move down, but ultimately it came right back down to the bottom of our value and held there, of course. The next month test that one more time, and finally the third bar here actually looked below, but immediately came right back in, and what does it do? It runs right back to our mean. So again, here we have the market's return back to value. It tests at outer extreme again. We found buyers once again. We close back inside of value one more time, close back in value, then we open right on the top of value, and what do? We run to the other side of value. So very similar price action and just rotations like we would see with market profile or volume profile or VWAP or anything else. It's very clear, and I like to look at channels in this way as opposed to just the outer extremes and the median. I think this gives us a lot more context. Okay, so here's the same, this is the monthly bars. This is what we were just looking at. Here's a zoomed out version looking at the previous swings, and we see how, we've got a bearish channel here where the market's, trading on both sides of that channel, just like you would see in a regular auction process, or rotating between the value extremes. Finally, the market finds balance. We break out to the other side. We're trading in value here. We test the high of the value, test the value low, and we're just trading in value for a while. We test those lower ends a few times there, and finally the market, we see a strong breakout of that value channel, I guess you could say. And of course we have that extreme move down, and ultimately we finally break out of that channel, and we have our new channel brought into play here. So again, it's just all these need to be anchored from key structural levels, but we can see how the market rotates between these extremes throughout that process. So again, that just helps us with identifying what's occurring, where are we in these channels, what kind of expectation do we have when we're trading at these extremes. So in this example we want to find resistance, in this example we want to find support. So it just really helps us with the overall context of the market. Here's the weekly bars, same kind of upward trend. It just really shows us more detail, I guess you could say, where we establish the high end of this channel. We have a buy side imbalance, then we return back to value. We test the value low several times, return right back up to our resistance area, and then we make a final strong pullback at the bottom of this channel or this extreme, and then we rotate right back to our median. Pull back to roughly the second standard deviation, back to the median, second standard deviation, back to the median, and then we've gone to the other side now, tested the median one more time, and we've bounced off that. And of course, since that point, we've traded higher from here. But again, we can see these very clear, buy side imbalances and sell side imbalances, and the opposing. If you were looking at a balance area or a bracket, we would see the same type of response. Response from sellers up here, response from buyers down here. Same concept. And then just here's a smaller reference channel. Again, just anchoring from key fractal points. A breakdown level here, and of course our fractal low here. And we can see that same type of behavior from support. We return to the median. We test that support one more time, back to the median, start testing the other side of value, and find sellers, pull back to our support area. So you can see just the same rotational behavior occurring there from the extremes that are providing the market with support and resistance. So that's pretty much it for price channels. Again, it's just in terms of the auction market theory process, we can see how by using the standard deviations from the mean, it speaks to us in the same way as we would look at, say, market profile or anything along those lines. It provides us with very clear areas of support, resistance, and of course areas that you would see the market rotate right back to, with that being the median. So with that being said, let's move on to our next section, which is the moving averages. So the moving averages are a key higher time frame reference. I realize they aren't within the context of traditional auction market theory, but they're heavily watched amongst the big players and are a great gauge of the current market conditions. The averages can also be looked at as a perception of value. And while I'm speaking of the averages here, I prefer to use the exponential moving average as opposed to the simple moving average, because I feel they're more dynamic, or they're engaged a lot more with the price bars as opposed to the simple moving averages. So with that being said, I utilize the following EMA periods. So actually I break them into two categories: short term and long term. My long term EMAs would be considered the 50, 100, and 200 EMAs, while the shorter term are the 5, 10, and 20s. So going back to the concept of value, as I said before, not everybody's looking at market profile. Not everyone's looking at VWAP structures. There are other ways to view the value. So the reason why I break these into two categories is simply that for shorter term traders, what do you think their value would be? Where do they want to be buying or adding to their position? It would be around the 5 EMA most likely, but also the 10 and 20 could be an area of value. Again, I would say the 5 is probably the most important in that sort of context. And then of course the longer term traders would be the 50, 100, and 200. That is their area of value. If they're able to buy the market around those moving averages, so long as the longer term trend is intact, they're very happy to pick those prices up. So again, not everybody looks at market profile, not everybody looks at VWAP, volume profiles, whatever. So this is also another way, or another way to view the developing value in the markets. So with that being said, when the market is trending, it's typically supported at the 5, 10, and 20 on the smaller pullbacks. And on the bigger pullbacks, of course, it's then the 50, 100, and 200. So let's take a look at what the shorter term moving averages look like. Again, this is just the S&P Cash Index, but these boxed in areas are representation of where we would see shorter term traders reacting to the moving averages. So here we have prices trading above the 5, 10, and 20. And in this particular example, the market, obviously was separated very far away from our moving averages. So there was a momentum of selling obviously occurring, and then finally when it got to that 20 and 10 and 20 EMA, we start to see buyer reaction there. And of course they bought that, and the market just immediately ran right back up to our resistance area and then onward. But we could see how the market really just kind of paused until, as I said, value catches up to price. In this case, it was the 5 EMA. Once value caught up to price, we can see more buying is starting to come into the market, and we finally see a strong push higher. And of course, we see liquidation come in, but ultimately we see the 20 EMA supporting the market, and then we've got a strong push higher again, and same thing all over again. Contrary to that, we see that there is some liquidation coming in the market here. Now the market's trading below our moving averages. We trade up into the 5, 10, and 20. We see selling come in, and we see selling response every time it touches the 5 EMA. In this example, here's a real clear example as well, where we get a strong move up and the market goes sideways again until value catches up to price. Once that occurs, the shorter term buyers are interested in continuing to buy this market higher. We see that over and over. Here's another example of that. Pause it until the value catches up to price. We get a strong push higher. We see pause, slight move higher again, pause, and then once that 5 EMA catches up, we see a strong push higher again. And that's just really all we're trying to see here is, where are we trading in relation to the shorter term averages if we're intraday traders. And contrary to that, on a longer term perspective, we see reaction from the longer term trader at the, of course, 50, 100, and 200. So looking left here, we see buying coming in on the 50 EMA here. We do see, I didn't box this out, but there's obviously buying occurring on the 100 here, and then we get to the 200, it really just pushes below, but this is where we'll start to see those real long-term buyers start stepping in here and buy around the 100, or excuse me, the 200 EMA, and we see that again right here. We see them step in here again, and we just see this over and over and over. So this is just evidence of longer term traders are seeing value in buying price at these lower levels, and of course stopping the shorter term trend and resuming the longer term trend. So very important information, and these higher time frame references are obviously very powerful. So the idea behind using these averages, as I said, is to build another layer of context and reference. We want to see what the higher time frame traders are referencing in the current market structure, and we also want to identify value for shorter term and longer term traders. Again, it just gives us kind of another frame of reference or line in the sand on how to filter our trade direction each day. Now let's move on to the volume weighted average price, or also known as VWAP. So with VWAP, I'm going to break this into three underlying parts. The first, I'll discuss the basics of this indicator or tool. Then I'll move on to how I use various VWAP periods to understand the market structure. And then the last piece, I'll talk about the Midas VWAP concept. I actually refer to it as an anchor VWAP because I use it slightly differently than the traditional use of the Midas VWAP, but ultimately some of the underlying significance is essentially the same. But I think it's a very dynamic tool to use in conducting technical analysis. So in the first section, the basics of VWAP. VWAP provides a clear sense of the market's current state, which is based on the periodicity in which we're referencing. VWAP can be considered an indicator as well as a synthetic order type that can be used to place an order in the market. And the way we want to look at VWAP is consistent with the underlying concepts of auction market theory, or the standard bell curve concept. So what we have here obviously is a standard bell curve with our standard deviations from each side of the mean, the 0 point you could say, and which essentially makes up our value, which is 68.2% of the time the market will be trading within. So that's just kind of the basics of looking at a bell curve, of course, but I'll show how we bring this into the VWAP concept. So first thing, just comparing other structures to what we're talking about here. Here's an example of a TPO profile. We've got our value area, and we've got our point of control. Very straightforward, similar to the bell curve. Here's a volume profile, similar thought. This white area is our value area, with the red line here is our point of control. Same concept, bell curve. Now looking at VWAP, we don't have a graphic like that, but what we do have is we do have our first standard deviation, or our value area, and we also have our point of control, which is the actual VWAP itself, or the value, the volume weighted average price. So in a sense, just the basic bell curve concept, this is our outer extremes and this is our median. Very simple. So with that being said, it does fall into that whole same thought process as that was what you would see with any sort of other auction market theory thinking. Of course, we could talk about how VWAP is calculated and all those other details, but in the context of what we're looking for and the way we're going to look at the indicator itself, it really isn't that important, because we're mostly concerned with the aesthetic value of what the indicator is providing us. So with that just general concept being known, let's start talking about section 2, which is using the various VWAP periods. So with VWAP, I assign the same periodicity hierarchy. I start with looking at the yearly VWAP, the quarterly VWAP, monthly, weekly, and lastly the daily VWAP. And the daily is really just more or less an intraday type of reference, which I won't really cover here, but obviously that is an important level to be watched, or important filter to be using on an intraday trading perspective. So really the goal remains the same: identify a market structure through various time filters. So let's take a look at what these look like and what it's kind of telling us. What we have here is the S&P or the ES contract. This is the yearly VWAP for this market. And what we see here, just a general thing, again, we're looking for context here. What do we see? Well, here's last year's value area down here. The market opened essentially above the previous session or our previous year's value. And immediately we see in the developing value of this current year, strong buying coming in. We make a pullback to VWAP. Obviously buyers step in very strong here, and we push back and we're imbalanced once again. And we finally get very far away from our value area, and buyers essentially back off. And we do see some liquidation come in, and we test the top of value 2 times and pull up to the 1.5 standard deviation, which I call an extension of value. And then ultimately we find more liquidation come in with that just no follow through there, and we pull back to VWAP for the second time. We see buyers step in once again. We pause at the top of value here briefly, but ultimately we broke through just strong again. So looking back to what we discussed earlier with one time framing, well, we can see that's definitely evident based upon this price action here. And then once the market pulled back to our VWAP in this particular example, we one time framed all the way to the top of value. We paused for several days, and ultimately we broke out of that value, one time framed higher until we got to our previous resistance, paused, buyers really just backed off once again, and ultimately pull back to value and pause again, where buyers started absorbing the market. We push higher, pull back to value, buyers step in again, and from that point on we've just been incredibly imbalanced to the buy side. So it's very clear based on what we're seeing here that we have a very strong rally in place. We do not see anything that tells us that the market is this trend has stopped. Every time it's tested VWAP, we've seen a very positive reaction. Here's another example. This is with crude oil. So what we see here is this yellow area is our previous year's value. What we saw here is the market actually looked below the previous year's value and came right back in to that value area. This again, just like what we looked at with the channels, what we looked like with our bracket areas, is that when we test a low end of this bracket or balance, or that extreme, we'll test the other side. So that's a destination move excuse me, to the other side of the previous year's value. We pause here and really just kind of, we do see that the market referenced that 1.5 standard deviation for a period of time, which, as I said, it's an extension of value, but ultimately, it really looked above and came right back in again. So that I guess you could say that strong move higher, really, this was kind of the confirming moment right in this particular bar right here, where we traded back into value and then tested the top of value and found sellers and came back into the year's developing value. So we can also see a destination trade occurring in this type of context, where the market came back up, tested the top of the developing value high, and immediately came right back and tested the value low. So, and then the market just returns right back to the median. We've seen this multiple times on the price channels and everything else. It's very clear, and it's a very obvious rotation that the market does over and over. So let's take a look at the quarterly VWAP. This again is the ES contract. What we're seeing here is we're seeing the migration of value in the previous points of control are stair-stepping higher throughout that entire period. We also see the markets responding very well. There are periods of balance that come into play. So for example, here's a small destination trade from one side of value to the other side. And then we see the market break out. The next quarter breaks out higher, and we pull back to our previous quarter's value and reject that and trade higher. We make one more pullback to our, actually this quarter opened inside of the previous quarter's value. We test the bottom end of that previous quarter's value. We find buyers there, and in this example, now the market's just bouncing off the top of value. So a lot of information there, but ultimately we can see how the market reacts to these very clear developing value areas as well as the previous value areas. But again, very strong trend in place. especially what we're seeing right here, where the market's trading outside of even the quarterly developing value, as well as the previous quarter's value, just completely blowing right through that. So very strong move in place there. And we can also see that when the market gets far away from value, we see a pause. So very good pieces of information to take note of there. Again, this is crude oil's quarterly VWAP. Same concept there. And let's just look from this quarter here. The market just completely became imbalanced to the buy side, and then we see it come back into the developing value and just kind of rotating back and forth. And into the end of that particular quarter, we see selling come into the market. The next quarter opens, the market pauses at the previous quarter's value, so this tells us something has changed, obviously, and the market rejects the previous quarter's value and sells off, tests the top of this kind of untested quarterly value there, pauses, stops on the bottom of the developing value for this current quarter, more selling comes in, hits the previous point of control or VWAP close there, pauses for quite some time, finally value catches up to price, we see more selling come in, and we come down and test the bottom of this, I guess you could say, naked value area that was from a few quarters ago. And since that point, the market has found balance. It has also returned back into the developing value area and has, immediately migrated right back to the quarterly VWAP there, and just simply pausing now. So again, this tells us directional bias when we see this kind of price action occurring here. Here's the monthly VWAP on the ES as well. Same type of thing, where we really just kind of looked below the previous month's value, came back in, the obvious destination then became the top of value, tested the top of the current month's developing value and rejected value, and really just continued to trade higher. And the market was so unbalanced at this point that it was referencing the 1.5, and really just kind of paused into the end of the month there. The next month opens up somewhat rotational, but still testing those highs. We find some liquidation there, comes down and tests the top of our previous month's value, rejects that, trades all the way back to our resistance area, pulls back to VWAP, and really just takes off. And then from that point on, we just kind of came a little bit into the developing value, but became imbalanced to the buy side once again. And of course, this current month, we again have opened outside of or above our previous quarter's, or excuse me, month's value, paused at the top of that value, the developing value catches up to price, pushes well into our previous month's value, but pulls back up to the current month's, you could say, point of control or VWAP, as well as our excuse me, previous month's value high close, and immediately comes right back to the point of control, finds support there, and buyers start becoming interested in those levels, and now we're imbalanced to the buy side. So again, very clear, typical rotational type behavior that's occurring within this monthly VWAP here. Here's another VWAP perspective. This is the excuse me, monthly VWAP for crude oil. Here again, we see that the market opened below our previous month's value area, and the market was able to break back in. It did find initial resistance at the value low close level, but it pulled back to the current month's point of control or VWAP. Buyers accumulated price there, and the market broke into the previous month's value, and then from that point on, it did test the bottom of that one more time, as well as confluence with the top of the developing value for the month. Buyers were accumulating all along here, and again, from one extreme to the other, we get to the other side and we see continued buying, push higher here, we pull back to value finally, and we're just trading really at the top of value, and the market still is looking to be imbalanced to the buy side. One interesting thing I'd probably want to bring forth as well is in terms of the contracts themselves. We know that crude oil will typically react to the monthly VWAP, and the reason for that, in my interpretation of that, is that crude oil is a monthly expiration. So we can really just see how the progress of this current month's trading is going based upon this developing value relative to our previous. So I feel that the monthly VWAP on the crude oil is a very important reference. Looking at, say, the ES, that's a quarterly expiration, so I feel that watching the quarterly VWAP on the ES is also important, simply because of the expiration. Of course, looking at crude oil, there obviously are a lot of the front month contracts or the forward month contracts being traded as well through spreads and whatnot, but I think the front month itself is a very important contract. It has the most volume, and it's obviously in line with this thought process of looking at the quarterly VWAP, the monthly VWAP in relation to those expirations. So we've just about reached a previous naked value low that had not been tested, and we found resistance there. We pulled back to value and just kind of were paused here at this point, but there is a potential for breaking into that current value area or previous value area, similar to what we did here. But again, very important levels occurring here. Okay, so here's again the ES contract. We're looking at the weekly VWAP filter. Again, we can see how reactive these levels are to this market, and this is where we can start to identify our trade locations. So not only does it provide us with a directional filter like the higher time frame references provide, but it also provides us with the shorter term information that we could actually look to be trading from. So in this example here, we see that the market opened well above our previous week's value. Really no interest from buyers up here, and the market sold down through, I guess you could say, some liquidation. We paused at the previous week's value high. We see a bounce right up to our developing point of control, or VWAP, and we see liquidation, more liquidation come in there, back to our key reference here with the previous week's value high, and somewhat supported again, and we finally are able to break above the current week's point of control, or VWAP, and get to the other side of value, the developing value, and we could just come right back to the value low, so just very rotational looking. And then for a short period of time, the market paused at the VWAP, or point of control, and we saw what looks to me just really just an attempt to push it down to buy at a lower price. So right back to our previous week's VWAP, or point of control, close level there. Buyers became renewed there, and we've just vertical move through this previous area, break outside of the previous week's value, break through the top of our developing week's value, and pause at the top of value and trade higher. That's just a clear signal that buyers become more in control. In this sample here, we see that really just rotational. I believe there was a holiday during that period of time, and just not much going on there, but just very rotational. It helps us with directional filters again. And in this example here, we see some liquidation come in, and they're selling it down. We get to the bottom of our previous week's value there, pull back to our point of control, more liquidation, and we just see this kind of rotational behavior at that point. This previous close level was holding the market there, and then we see the market trade right back through value, pause at the high again, and trade higher. And then of course the current week here, we see the same type of behavior where the market seeing some liquidation, so buyers aren't interested in buying up here, so the market has to pull back to the most recent sample of value, I guess you could say, and which is this previous week's value high, and we see some reaction at that point. So again, just very important information to help us with directional bias and potential trade locations that are occurring in the market. Let's take a look at the weekly VWAP for crude oil. We can also see the same type of behavior occurring here. Just looking from left to right, we see in this example the market opened within the previous week's value, looked above, came back in, tested the VWAP close, found some support there, but the developing value was not letting the market trade any higher. Ultimately, we break below that previous VWAP close and just blow right through the other end of value there. Finally test that previous week's lower extreme and come back, and we test the other side of the previous VWAP close as well as the current week's VWAP, or point of control. More selling comes in, we make a lower low, but just no follow through beyond that point. We rotate right back to that key level again. This time we're just kind of bouncing between that level. Next week, kind of the same type of behavior, really just kind of flipped to the other side. So testing the lows of that and then ultimately running to the highs and then coming back into balance. So same type of thing. And then the next week we see kind of the same. We see some liquidation off the previous VWAP close from this week. So this is really just overlapping values, so it tells us pretty balanced, but we are testing these lower and higher extremes. And of course this time we do break out of that value area and ultimately end up finding support. We test the bottom of the previous week's value close and pull back to the lower end of that range. And then of course the week next we immediately see buying off the previous week's value low, pulls back to really just a confluence of the developing VWAP as well as the previous VWAP close, and then we break out very strong higher there, top of value, and really just sitting on the top of value. And then the new week here is just kind of looking a bit rotational, but one of the key things here is this bounce right here, the top of our previous week's value close, as well as the developing point of control or VWAP, and we saw a strong bounce up out of there. So definitely some potential for higher prices, what we're seeing here. So that's pretty much the basics of looking at the various VWAP period filters and determining market structure and really just a directional bias on what we want to do with what those are telling us. And they're obviously very reactive to those key levels and can provide us with an excellent directional bias or filter, if you will, to look to trade in. And obviously, as I said, very, very powerful levels to use. So let's move on to section 3, which would be the anchor VWAP, which also, as I described, is similar to the Midas VWAP. I say anchor VWAP simply because we are anchoring from a key fractal point in the market. It's very dynamic in that way, so it's not a static time filter. It's really just based upon a key reversal or fractal point that the market provides us, and we can look to track how successful the buyers and sellers are from that key point. And again, this is applicable in the same periodicity hierarchy that I just walked you through. So let's take a look at a few of those examples. Okay, so what we have here is just a simply, this is the S&P contract, the ES. These are daily bars. We can see that there was somewhat of a bearish channel that was forming at that particular time. However, the market broke outside of that channel and it made a pullback to the top of that channel and obviously bounced up higher after that. So that is a key fractal point there. And what I have here is I've anchored a VWAP from that fractal low. And we can see as the market traded higher, again pulls back to the VWAP there, bounces off the top of value, comes back into balance, really just to the tick tests this VWAP and just rips higher here. So very imbalanced, very strong upward move occurring in the markets here. So I guess if I were to compare what I'm using or the way I'm using this versus say the traditional Midas VWAP, it's really just adding in that component of value or that developing value. So we have an upward sloping value, upward sloping VWAP or point of control, and we see that the market is imbalanced to the buy side rather than just only using the VWAP itself. So in a bigger picture we can see the market's trading well outside of value in this context. We can also use multiple VWAPs to really just analyze what the market's doing. So what I have here is these are multiple VWAPs plotting on a chart here. These are again the ES contract on a daily bar chart. We see the market's bouncing off VWAP several times, but we also see that the market formed a key kind of fractal high there. Apologize for the misspelling there, but that meant to say May 21st, but anyway, that was a Fed day, and we had a kind of a spike move and liquidation, and we see that there was some reaction from this VWAP, but it was not as clean, I guess you could say. In this particular bar, the market did trade it well above this VWAP from the highs, but it ended up closing roughly on it or just below it, and then we do finally see the market selling down here. We test the value high from this particular year, we come right back up to the VWAP from the highs here, test it one more time, and ultimately the market breaks through, and that's really just a heads up that we have potentially a rotational environment coming into play here. But really we just saw a very strong move back to our yearly VWAP, and to the tick it bounces higher. We can actually anchor more, I guess you could say, micro VWAP going in this way as well. So we have one going this way, clearly broke, but it did pause once again at this level here, but the market broke above all that, and we can see how the market was just basically very imbalanced to the buy side, and it paused, it kind of paused at the highs here, and then at once, of course, as soon as value caught up to price, we traded higher, and then we've pulled back to the top of value here again, and most likely traded higher from there. So the idea here is we were using 3 VWAPs, one bigger picture and then 2 more micro kind of dynamic VWAPs in that example. Okay, so now let's look at the anchor VWAP on a much greater time frame. So what we have here are just our monthly bars, and let's look far left. This is again the ES contract. It's back adjusted, so it obviously will have a lower high because we had that lower low and everything, so it just back adjusts everything. I'll talk more about continuous contracts and continuous back adjusted contracts later, but I prefer to use the back adjusted, and I'll explain why in another presentation later down the road. But in the event here we have a key fractal low here, and the market takes off and really just kind of bouncing off the top of value here. Then we kind of come into somewhat of a resistance area, and we see the market trade back into value, and in this particular bar here we see the market actually break below our point of control, or our VWAP, and almost to the other side of value there. But it does close above the VWAP, so you can almost say that was potentially a buying tail there. But in the next month we do have a close well below our point of control, or our VWAP, so that confirms that move is really done, or the VWAP is broken there. So buyers are no longer really in control there. Either we're rotational or the trend has changed to the other way. So when that occurs, we would obviously want to pull from the previous swing high here. So what we see here is we've got an anchored VWAP from the high. This is the bar again where we broke the previous VWAP. Once that occurred, the market tested those lows once again. Here was the CNBC double bottom, as they are famously coined as. But the market pulls back to our VWAP from the highs, and we see very clear rejection there, or liquidation come in again. And then we see a strong push back down. CNBC is proven wrong, and we pull back to the bottom of the developing value from the high here. We see further rejection, very strong selling, and we make new lows there, and the market begins to reference the 1.5 or that extension of value here, and we continue to look for lower and lower prices. Then ultimately the market comes back into our developing value and rips right back to our VWAP. And then what happens here is we get this particular bar here, we see a very strong close above the VWAP from the highs. So again, what do we do in a scenario like this? Well, we anchor from this key fractal to the low or the bottom. So again, we've anchored from this low, and we see that the market pulls back to here's our confirmation breaking of the VWAP from the highs in this particular bar here, and then we've drawn from the other end now, and we see the market pull back to VWAP here, and we see renewed buying come into the market. We push higher, we pull back to VWAP one more time, and then we push higher again, and then this last time we test the top of value, and buyers respond to that again, and then really just referencing the 1.5 at that point. Just again, very, very strong move higher here. So by looking at these several swings that occurred here, we can clearly see when the trend has changed, and it's really just when we see that break of these larger scale points of control, or VWAPs. And as I showed, when that happens, we want to pull from the other direction, and then we see that confirmation. So that's a confirmation, this was a confirmation. So that's what we're looking for that major structural breakdown in the longer term trend. And of course, by looking at our current scenario, we simply do not see anything close to that at all. So very, very important to take note of that. So now that we've covered the VWAP, let's start to look into more, I guess you could say, complex ways of analyzing the market in terms of looking at market profiles, volume profiles, and lastly, how to track the cumulative delta on a larger time frame. So in this section, I'll cover how I use the market profile and the volume profiles to conduct my top-down technical analysis on the market. And I would have to say that this is somewhat of an advanced section, which is, again, centered around the bigger picture context and analysis. But if you're new to market profile, this might be a little more advanced for you, and this is certainly not a market profile 101 type of explanation. I won't be talking about intraday trading or how I use market profile for my intraday trading. This is again just all about the top-down technical analysis to understand the overall market structure from a macro to micro view. If you're new to market profile, I highly recommend reading the following books here. First one would be Stoudemire on markets. Trading with the market profile, very, very excellent book to read there. And of course, Jim Dalton's Mind Over Markets, and also Markets and Profile. These books will help you establish a very solid foundation of knowledge in looking at the market profile in general, or understanding it in general. Additionally, there are a couple of websites I think that are very powerful. Of course, Jim Dalton and Pete Stoudemire have their own websites that you can obviously visit, and in fact Jim Dalton does a lot of great webinars and presentations on just looking at market profile alone and understanding what's going on in the markets there. So I highly recommend visiting their websites. But there's also Don Jones's website of Cisco Futures. He was one of the pioneers of market profile as well, and he's well known for the overlay demand curves graphic. It's really just a merged market profile graphic and volume profile graphic based on time filters. Also take a look at Doug Tucker's market profile primer. Just really great solid information, pretty well known across the trading industry as great pieces of information or educational content for you. And of course the good old CBOT market profile handbook. Really, just if you just were to Google any of these websites, you'll find this information fairly easily. So I highly recommend really being in the know of what this is all about before really being able to comprehend what I'm going to be going into here. And again, this is all just really bigger picture stuff, not intraday trading or anything along those lines. So again, with my top-down analysis using market profile, I apply the same periodicity hierarchy that I do with everything else. So I start with using the yearly profiles, the quarterly profiles, monthly profiles, weekly profiles, and I do look at the daily profiles in this sense. And of course, I use the overlay demand curve profiles. Really what I refer to these as more or less just composites that are they are not time filter based. They're more or less dynamic based upon market structure, and I'll go into that later. Because we're looking at such large time frames, we need to adjust the price levels that we use in looking at these graphics. So for example, on the yearly profiles, I mean, these are huge levels. So, and this is for the ES, and of course these will change across different markets based on their ranges and whatnot. But for the ES, I think it could be platform specific as well. But with Sierra Chart, which is the platform that I use, I prefer to use 20 price levels for the yearly profiles. Again, we aren't looking for small detail specific levels. These are more or less just bigger picture context is what we're looking for. Moving down to the quarterly profiles, we can actually shrink these down quite a bit. And again, maybe this is platform specific, or maybe I'm not doing this correctly, but I feel that this works very well for the way I've looked at this. And quarterly profiles, I feel that 4 price levels tend to be a great rounding. Same applies for the monthly. 4 levels seem to work very well. And then the weekly, we can actually go down to what we would typically look at. And the whole idea here, why I'm using these different filters again, is, you know, these are huge levels, but we also want to drown out a lot of the noise that can be present if we use too small of a price level rounding. So on the weekly and the daily profiles, I can just use my typical 2 ticks, or 2 tick levels there. And the same applies with the overlay or composite profiles, just 2 ticks. And again, this is specific to the ES. I can always, if you're interested, I can provide you with what I use in other markets such as crude oil, which have wider ranges and whatnot. But I found that on the ES, these seem to be very powerful. So now that we've discussed kind of the basic settings of how these profiles are set up, let's talk about what are we looking for here. First of all, what kind of profile type is the market showing us? Is it, you know, what's the shape of it in those kind of basic market profile concepts? What does the high and low look like? Is it is there excess at those highs and at those lows, or do we have poor highs at maybe you know, the high end of the profile, or do we have poor lows in place? Really, what that tells us is that there's potential further business to be conducted at those extremes. You know, what's the migration of value and the point of control in these profiles? Has it been you know, stair-stepping higher or lower based upon the trend? We really want to kind of look for that type of information. Do we see value areas overlapping each other, or are they separated? This kind of gives us a sense of how strong the move is. And then of course we want to look at the overall profile in terms of are they balanced, meaning that they're overlapping the previous profile, or are they one time framing, meaning that they're continually looking for higher prices or lower prices. So just overall structure in that sense, similar to what we looked at with the price bar charts. Okay, so let's take a look at the profiles themselves. What we have here again is the ES contract, and we have our large time frame profiles being plotted onto our chart. There's a couple things that we can see. Of course, as I had mentioned in the previous piece of what we're looking for here, so let's talk through this here. So again, the current profile type is an elongated trend profile. It had an opening drive and has been auctioning higher in price discovery mode. Really what we're seeing here is this complete rejection of our previous profile. Not only that, but we're seeing a very long elongated profile compared to what we had previously. So very important piece of information, just that alone. Not only that, but this was our previous swing high here, which was a balanced profile, and we don't see really any balance being shown in this current profile. We can also see that the market established a clear excess at the profile low with the buying tail, and has established some excess at the high. And just as a side note, looking, of course these are very big levels here, but typically excess should be at least 2 TPOs or more, and that's just my personal preference. Maybe people would look at maybe a higher number or whatever, but I think, you know, just looking left, I mean, here was the all-time high previously, and we had 2 TPOs at the high there as well. So I think that's definitely good excess occurring there. And what I mean by the excess as opposed to maybe a poor high is, you know, when we see excess, that just simply tells us the market has exhausted itself on one side of the order flow. Same with the low end of this particular, so this is a very nice balanced profile. And looking at again at the current profile here, we have an opening drive, and so some good excess at the lows and some excess at the highs, but really not much there. And of course we have a poor high here and a poor high here. That simply tells us that there probably is more business to be done there. So the next piece is looking at the value migration over the last 3 years. We can see a strong migration higher with the current year's value not overlapping the previous. So very major dislocation there. I mean, it is questionable to say that even the market has found value yet, but we can see that it's, you know, far, far higher than where we were previously from a somewhat balanced type profile. Very important piece of information. We can also see the market found support off the previous 2 years' points of control till finally this year having an opening drive off the top of last year's excess ledge area, which would be this area here. So a ledge is, in my opinion, at least 3 TPOs or more. Sometimes 2 will work, but typically I like to see 3 TPOs there. And then, of course, as I referenced, here's the point of control. The market opened essentially right on that level, tested it, and took off higher. The profile beforehand, you know, opened all the way up here at the previous year profile's high, came down, tested that point of control, and auctioned right back to those highs. So when you see the market test the fairest price or the most traded price, or in this example TPOs where the market spent the most time, and it rejects that, that just tells us that something significant has changed. In addition to these rejections, we see the market has been one time framing for the last few years. We also saw that on the price bar charts. But again, very important pieces of information occurring there, very strong trend in place. So as I said also is another notable thing here is the previous year's profile was fairly balanced. However, the current year's profile is imbalanced to the buy side, and as we're going into these all-time highs. Again, what does that tell us? Well, the market kind of found two-way trade there and some balance, and all of a sudden something has changed, and we completely reject our previous year's range or balance. And not only that, but we completely blow through our previous, or the all-time highs balance as well. So really spent very, very little time at these levels. So the market is completely out of balance and very strong trend higher here. Okay, so let's take a look at this a little differently. What I have here is, you know, if we split out the current year's profile, we can see the market was one time framing higher until June, or the F period. So we're kind of now starting to look into a little more detail. So again, each TPO bracket represents a month out of the year. So one time framing, and then it stopped right here on this small pullback, but of course that is resumed as we took out that previous high there. We then ran back up to the highs and appear to have found sellers, which is indicative of a bracket forming. So that would be the E period here. So really, actually, I should take that back, or step back a bit here and say that, you know, here was our high. We made a small pullback and then really ran up to the highs again, and then we can see at this current period of time, H period took out the high of G and is now falling back into the range here. So what I meant there is that potential of a bracket forming. So the bracket low would have been somewhere around the point of control, and the bracket high would have been most likely somewhere you know, in this upper area here. And of course a break below the bracket would take the market back into the previous balance area most likely. So if there's rejection here, you know, we could fill in more of this TPO, or this, you know, short period or short time spent at these levels, but you know, a major rejection of that could easily make the market migrate back into this range here. And of course, you know, a break above the bracket would simply signal further price discovery. And in fact, this was somewhat of a dated chart, and we've obviously since gone well above these levels. So now let's kind of look a little closer at some details here with the quarterly profiles. So again, going through our filter process, we can identify the following. First, the current profile appears to be trending higher, although it spent a lot of time at the highs, suggesting balance and two-way trade has returned to the market. The market, for the most part, has rejected the low TPO areas, with the exception of filling in TPOs at the 1610 to 1620 area. So that would be this area right here. We don't have excess at the highs, so we have a poor high in place. And the market has continued to build higher value over the last few quarters with very little overlap. And lastly, the market has been one time framing higher for several quarters. So let's just stop there and look at this a little closer. So we can see the previous quarter that we had essentially two balance areas and some excess at the highs, but between these we did have low TPO or low usage areas. We can see that the market in this current quarter has reacted to them with the exception of this here, but this is a part of kind of a, as we can see, a greater balance area, and I'll kind of talk about this later. But this is really important to note. So if you were to flip this profile the other way, we can see that the market, all it did here was just simply fill in this area here, and as soon as we got to this ledge, rejected that and immediately ran to the other extreme and paused there. And you know, we see that there's a gap there. This is an RTH profile. The market gaps up and rejects the other side. So this TPO area, or this low usage area, is you know, there's no interest in the market trading there any further. So when it rejects that, what is it going to do? Well, it immediately rotates to the previous high. Once we got above that, which is a very, very visual level, the market pauses. So what do? We build balance and value at these highs, and really, you know, obviously we can see here at this current time the market's really just kind of trading, you know, at that level, but it spent a lot of time balancing up here, came back and tested this level, and obviously the idea then is it's just rotating between these two extremes at this point. So we've established a new balance area at these higher prices, and if the auction was going to continue higher, what, you know, it's the same thing as when we look at a bracket or a balance area. We see that buyers are more interested in prices when they're down at these lower ends of the curve, I guess you could say, and of course sellers are interested at these higher prices. And then when things change, you know, let's just say, and obviously this has happened, is the market ran back up to these highs, and this time sellers did not step in. They just continued to accept higher prices. So when I say buyers and sellers, you know, obviously we're in a very strong trend higher here, and the majority or the bigger players in the market are the ones that are really pushing price around. So when I'm saying sellers, I'm not necessarily saying people are trying to short the market. It's very important to know that. When I say sellers, that means that people are interested in taking some of their risk off at these extremes. Obviously the bigger picture tells us that the trend is higher. However, when we get to these extremes, we want to see reaction from sellers or from buyers here. When we don't see a reaction from the sellers, that means that something has changed in the term, in the concept of value, or the perception of value, and the market looks for higher prices or price discovery. When we look for price discovery, all we're doing is trying to find where those sellers are interested in stepping in and selling again. And again, as I said, this is not in the sense of identifying short sellers. I think that's very important to note that. All I'm pointing out is where the longer term is looking to take, you know, some of their position off at those levels. They are obviously trading with the flow of the overall market, which is to the upside. Just as a side note as well, you know, the market is never really at risk of short sellers. I think sometimes people don't really quite understand that. You know, the market is at risk of liquidation, meaning that there's no more buyers. There's more sellers than buyers. Bigger players are selling aggressively to get out of their position, and they're not buying at lower prices, so they're really just stepping aside. And that's when you see these really big corrections, is because they're backing off. So the market is not at risk of short sellers entering the market, so don't worry about short interest in that sense. It's really the risk is in terms of liquidation, and if there's major liquidation and panic selling, obviously that's where the market will see those big corrections. So I just wanted to quickly touch upon that. Let's dive in a little deeper and look at the weekly profiles. I skipped the quarterly. The quarterly looks pretty similar to the, I'm sorry, I skipped the monthly, not the quarterly. The monthly profiles look very similar to the quarterly, so I felt maybe just skip a little forward here and look at the weekly, just so it doesn't become too, I guess, repetitive. So let's look at the weekly here, and again, just look through those same filters that we want to see. So first of all, the current profile is elongated to the downside with a significant gap beneath it. The previous week spent far less time auctioning at the highs, so that would be this week here. Spent far less time auctioning at the highs than the previous. We do not have much excess at the all-time highs with the double top in place. So, of course, this is obviously important information. Value had been migrating higher before the previous week, which had a small value within the previous value area. The current week's value is still within the previous week's value. So we've got overlapping occurring there. And lastly, the weekly profiles had been one time framing higher until a clear change in perception and the break below the distribution channel, which eventually took out the previous week's low, so the pullback we see here. So what we have here, what I've drawn, is based on the distributions of these profiles, we can clearly see that there is somewhat of a channel forming. And then on this profile here, this particular week, we actually broke above it. And we can see that the market pauses right at the top of this channel, and really all it's doing is the market's trying to accept prices here and see, are buyers still willing to continue to push this higher and higher, or have we found sellers? The next week opens in the same range and actually does find sellers. So buyers just weren't interested in these higher prices above the channel, and the market comes back into the channel. So we kind of just balance back in our previous channel here, and finally, the next week we test our point of, previous week's point of control and find rejection there, and test the bottom of the channel, and what happens? We break below it. And what does the market do? It pauses for a while again and balances below the channel. But ultimately, the market ends up gapping down and really just kind of fills in this gap from here. But the idea here is buyers still did not step in here, so it had to pull all the way back down here to start to find buyers again. Doing that, we also filled in a key structural reference here, which is this big gap down here. So again, what does this tell us in the context of a bigger picture, top-down technical analysis? Well, of course, on a more detailed, smaller time frame, we can see that there was some liquidation that came in, and the market had to make a pullback and kind of just broke that one time framing price behavior that was moving higher there. So for intraday trading, we're seeing this type of behavior, and we see the market rejected off the previous week's point of control and break below that channel. I mean, that just clearly gives us a heads up that watch out, there's definitely a pullback about to occur here, and sure enough, that's what happened. Again, this is a very important structural reference here. The market just about closed that full gap out, but really just balanced there. So really just taking out, it kind of provided one of those kind of domino effects with there being stops below each of these week's lows. And then once it got below all of that, we see kind of balancing occurring there. So maybe inventory being cleared out on the shorter time frame, and also maybe longer term buyers absorbing these lower prices. Okay, so now let's dig even deeper here and zoom in more with the daily profiles. Again, the same process. So the market's trading within a 4-day balance area, which is a gap down from the previous balance area. So this is our current balance right here, and this is our previous balance. Value is migrating from one extreme of the balance to the other, with the most recent session forming a clear value at the lowest level of the 4-day balance. So that would be this profile here. We have some clear buying tails at the bottom of the balance, with very little excess established at the highs of the balance. So what is that telling us? It's saying that, okay, yeah, the market gapped down, but we're balancing now. But every time we test the lower end of these extremes, of this extreme, we see buyer reaction there. And then when we trade to the high end, there's just no follow through quite yet. So the market tests the lower end of this balance area once again. Maybe there were stops below this buying tail here, which would be representative of this distribution here. But this spike kind of lower and then run right back into the middle of the profile is essentially to be construed as a buying tail as well. So when we look at this, we can see that the path of least resistance is really just balanced, meaning that trading from the market's balanced extremes are the most appropriate thing to do until something obviously changes. We can also see that every session within this balance has experienced a relatively weak close, which is kind of highlighted with the pink lettering, with the market falling into the middle of the day's range, with the exception of the most recent session showing a bounce, or the buying tail right here, and where we just closed in the middle of the range. This is further evidence of balance, of course. So no breakout here, the market falls right back into the middle of balance. Same here, buying tail comes up to our previous profile's volume point of control and really could not trade above that, and just kind of falls back and closes at the value low from the previous session. So again, just very balanced, and then we do hit this extreme and no follow through. So like I said, just kind of closes right back in the middle of the balance area. I wouldn't say this is necessarily a weak close, but what it's just showing us is that there's no conviction to trade higher quite at this point. So it just falls back into our overall balance area. And then the last thing, the most recent session could not trade above the balance area and took out the previous session's low. So we opened all the way up here and really just no follow through there, came down, took out that previous low. But of course, again, once we did reach the lower end of our overall balance, buyer stepped in again. So all we're doing here is, if I were looking to buy this market, I'd only be interested in buying from this lower area here, and then if I'm looking to sell, I'd be from this area up here. It's that simple. In this profile here, there's really not much to do until we got down here. So that's the whole supply and demand, I guess you could say, side of the bracket area there. So by looking at these, or recognizing these balance areas, it really does help us with even our intraday trading as to how we want to, what's our directional filter when we see something like this. Okay, so now that we've talked about just the static time filter ways of looking at these profiles and what they mean, what are some of the details that they're providing us, so we can actually start to look at some of the composite or the overlay demand curve, as I had mentioned earlier. And this is what I would say more of a dynamic way of looking at market profile in that sense. So as I said, this is also known as the overlay demand curves, and in this process you can choose to use the standard the 5 days, 10 days, 20 or 15 or 20 day composites, or like I said, I use more of a discretionary composite, which is based on market structure. The reason for this is the market will obviously trade between balance to imbalance and back into balance, and my goal in observing this is to create a composite of the balance areas to view the auction migration over time until the market becomes imbalanced once again, or to provide a more dynamic way of seeing how the market is rotating between these balance areas. I think this is helpful in defining key structural support and resistance areas, and in this example I have here, it's similar to what we just looked at on the previous chart, but it just shows where the market, this particular profile here was actually a gap down move, and the next day we kept looking for lower and lower prices. Then we have kind of an inside day, and then the market opens kind of in that lower range, looks below, and then immediately comes right back into that range on the next day there. So this I guess you could say spike into the close there was really just a buying tail as the overnight session took the market right back into balance. So we have right here a very clear balance area, and what I would do with this is create a composite with that And of course, what I was referencing in the previous is you know, the market was within the balance area here, and the next day the market gaps down all the way, you know, well far from our previous session and into those lower extremes. That just tells me that something really has changed there, and the market could be potentially accepting lower prices, and obviously it did as we traded within this lower balance area. And again, I would have created a composite for that lower acceptance area. So this is what it would look like. So we have two prominent profiles now here. So here was that upper balance area, you know, nice distribution, you know, bell curve looking profile here. We've got our point of control here, as well as our volume point of control sitting right here. And then of course, you know, we close essentially right in the middle of this profile, or at the fairest price. And then of course the next day the market opens outside of that previous profile's value, and really just down on the single prints there, or the double prints. So that just tells me that something significant has changed there, and I need to adjust my composite accordingly. So I've created a new composite, and of course I keep the current session outside of that to see how the market is reacting to these new levels. So again, looking at that current balance area, you know, as I said, the market opened somewhat in the middle of this range. There's really nothing to do there, but once the market traded down to our lower extreme, we have a clear trade location here, and we also have clear risk. We just don't want to see the market take out that buying tail. So in the context of everything, and this is again kind of really getting into more of the detail stuff with trade location and directional bias, but these profiles help us immensely with how we want to filter our trades, and just that path of least resistance. So again, as I said in the previous part, is that in this balance area, our path of least resistance is, you could say, rotational, meaning that when the market's trading at the upper extreme, we want to be sellers. When it's trading at the lower extreme, we want to be buyers. It's that simple, and we continue to do this until something changes, just like this here. So again, here we close at the fairest price. The next day we open way outside of value. That tells me something has changed. And you know, let's just say, for example, the next day after this session, you know, we again have a nice, you know, looking profile with a poor high. Let's say the market opens above here. I would expect the market to come in and test this upper range here, if not, you know, the fairest price. And if it rejects that, well, that's pretty clear that the market is looking to, you know, retrace this area, and this would obviously become our next important reference here, this volume point of control. And just speaking in terms of looking at potential areas or reaction areas that I want to see the market rotate to, you know, I really put a lot of significance on the volume point of control in this sense over the TPO point of control. And reason for that is simply this is where the most volume has been traded. It represents a high area of liquidity. So excellent target areas for trades coming out of this. And subsequently, I believe the market did run right to this level. So that's how I look at these composites, is that I want to use them in the sense of how it's telling me structure or perception of value has changed in the markets, rather than just using a time filter, or static time filter, because I think this is more dynamic and it's more reactionary based upon overall context. So we've kind of talked about rotations between composites and you know, clear high volume areas and low volume areas, or low TPO areas. Let's take a look at some volume composites now as well. And again, this is the S&P contract, the ES on a daily bar chart, regular trading hours, RTH. And what we're envisioning here is seeing how the market is rotating between these high volume areas as the auction moves higher and lower. So what I've done here is I've circled real high volume or balance areas, as well as we can see between these are low volume areas where the market really just has not spent any time in trading and filling in volume. So the expectation is that the market rotates excuse me, between these extremes until something changes, and then you know, this example here, we're seeing price discovery. So as the market keeps trading higher, it's establishing these small balance areas, and then we move higher and we test the previous balance or that extreme, and continue to look for higher prices. So if we were to extend these circles out and see how the market's reacting, we would see something like this. So here's our upper balance area, so the market just kind of rotating between these two levels. Same here, we gap up and establish a new price discovery area, so we test the high and low of there, and then we break out here and we test the top of that here and move higher. Here's another big balance area, so high to low, high to, it's just kind of rotating between these levels. And again, these are this profile that I have plotted on the far right here is just of the current year's volume plotting on the chart. I know that people use longer time frame profiles or composites as well, but to me, I think the most recent prices are the most important. And there's a lot, when you're looking at futures contracts, there's a lot of little intricacies that could offset and provide you with levels that may not be the same as what other people are looking at. And that was kind of what I was referring to earlier with the whole concept of back adjusted contracts and continuous contracts. And the further out the information, our minds seem to forget these levels. So obviously there's psychological levels like all-time highs and things like that, but these little volume profile extremes are not, you're most likely not going to be remembered, from a few years from now. So I think it's important to use somewhat fresh data when we're looking at that. Of course, we're at all-time highs anyway, so this is all just price discovery here, and we're just rotating between these newly established volume areas. But I think it's helpful in looking at more recent, I guess you could say the most recent perception of value, rather than looking at value from a long time ago. So that's just, again, my personal preference. But I feel that looking at volume profiles on a composite histogram like I have plotted here is probably the most powerful way of doing this. And we can see just by the clear reaction of the market that we see clear rotations occurring there. But I think this is a very powerful way of looking at it, and it's an important way of looking at that, because we can see where the market may spend more time filling in volume. So if we look at this area here, we do have a low volume area in the middle of this kind of significant profile here. Any failure up here, we may see the market come back and fill this in a bit. So those are kind of the things we want to watch for as well. But again, just kind of envisioning the rotations that are occurring are very powerful in looking at it in this way. So now that we've talked about market profile and volume profiles, essentially the same things, same way to look at it, and how they rotate between each other. Let's look at the cumulative delta. Since we're on the topic of volume and everything, and see how looking at this on a larger time frame helps us with understanding the overall market context and structure. So first of all, we need to ask, what is cumulative delta? Well, cumulative delta is simply the difference between the ask volume and bid volume, which is being displayed in price bars. The importance of looking at cumulative delta is that it shows order flow character, or otherwise said is measuring the aggressiveness between buyers and sellers. So how does cumulative delta show aggressive behavior? This is shown through the market orders hitting the tape. Market orders represent aggressive behavior, and that traders are not willing to wait for a limit order to be filled and are entering via market orders. So if someone is being very aggressive with entering the market, and they don't want to wait to say their limit being hit, they're most likely going to enter the market via market order rather than just sitting around and waiting. They're fearing that they may not get filled on the limit order. So it represents aggressive behavior in that way. And also, if a seller wants to really sell the market down, that would be seen as hitting the bid, for example. So sell market orders will obviously fill on the other side of the market or at the bid. Contrary to that, buy market orders are going to fill on the offer. So at the market, the best price available, which would be the other side of the tape, obviously. So let's take a look at what this appears like on a chart. So this is just an intraday chart. My point in showing this is not to show you any sort of trading techniques or anything like that. It's really just to give you a sense of what the market delta looks like in terms of what I've just described. So I said it's portrayed on a chart in the form of a candlestick. I mean, you can use open, high, low, and closed bars, or just line chart. There's multiple ways of doing this, but I think this is probably the easiest in seeing what's occurring here. So this is just a plain chart. What we can see here is there's a volume-based chart that sellers were aggressive in selling this market down. Again, we see that that was represented on the cumulative delta. And then we made a small pullback and we went sideways for a while, and we see that delta also kind of came right back up to where we were balancing at before, and just sideways price action, and eventually we see that both price and delta is starting to drop again. We see more aggressive selling come in. Once again we see pause, and then one more time we see selling come in, and then we see a bounce. So the market takes out this small little swing high here. However, delta kind of just pauses at that previous little balance area as well. So we see price kind of stall out up here, and it makes a pullback. And what we're seeing here, and this is kind of what I'll go into more on a larger time frame, but what we're seeing here is that, again, we see aggressive sellers coming in here, and we see the delta drop all the way back to our lows, maybe even make a lower low, but we don't see price going as low as that. So what does that tell us? Well, that's obviously a divergence between price and the cumulative delta there. So when we have a divergence, what is that telling us? Well, we know that sellers are being aggressive in this example here. However, price does not make a new low or even come back to our lows. So as sellers are selling into price, the markets, for some reason or another, it stops. It does not go any lower. So what does that tell us? Well, sellers are not being successful with hitting the bid lower. They're not seeing success with this market trading lower. And what's happening is buyers are stepping in and they're absorbing the sellers. So as these guys are hitting the bid, trying to push the market down, buyers are actually absorbing those sell orders and keeping price from dropping, or they're interested in that. So picture somebody trading in the pit, and the market selling, the aggressive selling coming in, and for whatever reason the selling backs off or dies out, and then we see kind of two-way trade come back into the market, and then all of a sudden another wave of sellers are step in there, and all of a sudden out of nowhere a very large player steps in and starts buying all of their sell orders. So they keep trying to sell into him, and he buys it all. He absorbs up all of their sell orders, and there's no more to sell. The inventory is just really taken out, I guess you could say, in as far as more to sell there. And what happens now is the market comes right back up, and anybody that is short in this area here obviously is starting to panic, and they start covering, and this causes a reversal, obviously. So absorption came in, the guy stepped into the pit and bought all these orders up, and I'm not saying this is pit trading here, but I'm just as an example, absorbed all the sellers, and the sellers basically were cut off, and buyers recognized this divergence, obviously, and more buyers felt comfortable stepping back into the market, and we traded higher. So that's what we're trying to see as a general concept with cumulative delta. And again, what that would be is aggressive behavior as well as passive behavior, and we can see that through divergences. So let's start to look at some larger perspective time frames here. What we have here is a 500,000 volume bar chart. This is on the ES. Obviously huge volume in this market, which allows for us to use these huge volume bar settings. So what we can see, again, just like we were looking at before, is very significant fractal bottom here in the market. We see the market trades higher and just kind of pauses, and we do see we could not take out that previous high, and we see some liquidation come into the market, price makes a pretty good lower low, where delta did not quite make as much of a low there. So that it just a clear sense of more buyers stepped in here. Sellers sold down, and again they were cut off, and the market goes the other way. We see a nice fractal there, or a doji, and the market trades higher. And then now we take out that previous high here, and we're trading higher, and then we pause and we make a small pullback. Nothing significant there on delta either. And then we trade higher, we take out that previous high, and we just kind of pause again at these highs. So we can see the market made higher highs, but now we see on delta that it did not make higher highs. So what does that tell us? Well, maybe there is some short covering there, but once it got up to these highs, and maybe the stops got cleared out from the shorts, there was no follow through from buyers. So this was really just a kind of a small little stop run type thing, and that was it. And we see that buyers were not participating beyond this small, they probably got out at this swing high here as stops were being hit. That's an area of liquidity, obviously. We know there's inventory sitting up there. So that gets cleared out, and the market immediately comes falling right back, and we see aggressive selling coming in now. So that's what we want to see on a larger time frame. That just gives us a good sense of direction is in terms of potential deeper pullbacks that could be coming into the market there, and that's what we saw, obviously. Let's take another example here. This is actually of crude oil. I believe this is a 40,000 volume chart, so thinner market, less of the setting on the volume bars. Just as a side note, I like to look at the delta, the cumulative delta, paired with the volume bar charts, as opposed to, or tick bar if you want it, as opposed to a time-based chart. And the reason for that is simply these volume bars eliminate a lot of the noise that time-based charts would when looking at this. So this is my preference there. But in any event, we see the same type of behavior here. We've got a somewhat of a balance area, and then finally the market sells off from that balance. We see that reflective in the delta, and we see that the market really just came and tested the lower end of that excuse me, level there. And what that tells me is anybody long there, once the market came back to these prices here, they most likely covered their long positions if they didn't get stopped out. So they got out, obviously for a loss there if they're long from here. But anyway, we can see that reflective in the delta there, and then we see more selling come in, and then we see a very strong, vertical move down here, just very strong move. But what we're seeing on the price though is that it's not as strong. So again, as I just walked through on that smaller references, we see sellers are really hitting the bid going down here, but they're not being very successful in getting the market lower. So what does that tell us? It tells us that there's buyers absorbing these lower prices. And then finally we see kind of a flush lower. So this is maybe some weak hands or had stops sitting down here, and market flushes lower, takes out those stops, and then immediately comes right back into that range. What does that look like on our delta then? So again, we see a strong move down, not very successful. So maybe some covering is starting to come in, and then finally we get that flush move lower. However, delta does not make a lower low. So I guess that's a little opposite of what I just showed in the previous chart. But again, it's a divergence that we want to take note of. Price made a lower low, but delta did not. That just meant that buyers absorbed these lower prices as well. So kind of a little opposite of what we just looked at, but it means the same thing. And again, it's a good heads up that there's potentially a strong reversal about to occur. And sure enough, since that point, this market has traded much higher. We can also, what we can do here is, we're looking at the same chart, zoomed out a little bit, but same thing. And what I have here is that I've gone back to the whole VWAP concept. Is I've got an anchored VWAP from this key breakdown fractal point. So here we have these lows here. From this high, the market broke below that support. So I've anchored a VWAP from this high, and we can see that the market was reactive to the ongoing VWAP here as the market continued to trade along here. and ultimately it broke down and became incredibly imbalanced to the sell side. What we have below here is a volatility-based moving average. Just the reason why I have this on here is it appears to be very reactive to the market when it excuse me, reaches this level here. So think of it in the same terms as any other volatility-based reference or even a VWAP, is that we typically will see some sort of a reaction there, and finally it broke through there. We saw the market trade back into value here, and then it tested the top of that, and really that was confluent with the value low, so it was somewhat of a brief balance, but for whatever reason the market fell back out of balance here. We saw more selling from VWAP, and now we were trading below our volatility based moving average, and then on the pullback here was confluent with our VWAP. So again, just kind of confirmation here, but we see again that strong liquidation as the market goes lower, and just kind of going crazy. Of course it did get above our moving average here a bit, but it ultimately fell right back below. We're still trading outside of value, and again here we see that being reacted. We see a double top type thing here with major divergence there, and selling really pushed lower here. However, price really didn't get that much lower, and then we see our flush here, and then we see this strong break above our moving average right here, which was really a heads up before the market came back into value. We also see our volume profile plotted to the right here, gives us a sense of our balance areas and where we can typically expect the market to rotate between. So we had a distribution here, and then a fast move, and then we have a distribution here. So it all comes together in that way, and this is why I like to look at it in this sense, is just giving us kind of a marriage of all this information into one chart like this. So a very powerful reference in that. So I think it's a very helpful analysis tool looking at the bigger picture. So that's it for the market profile, volume profile, and cumulative delta. And the idea then, as I had said before, as I walked through, is looking at the path of least resistance, looking at the bigger picture market structure, but also measuring the aggressiveness and successful outcome of either the buyers or sellers through the use of the cumulative delta. So it all comes together as a very nice, powerful piece of information. Okay, now let's take a look at how I draw up my support and resistance levels. Again, this is just larger time frame, more or less just reference, or it's a suggestion of there being support or resistance at a particular area. These are not being drawn out for specific trade locations. It's again just a suggestive idea that the market may be supported or find resistance at a particular level. So let's take a look at that. So what we're doing here is looking at support and resistance levels in the traditional sense. Not everybody's looking at market profile, VWAP, or EMAs for that to determine key levels of support and resistance. So what we're doing here is using traditional candlestick patterns that can provide us with clear levels of supply and demand. Each candle provides us with information similar to looking at a market profile graphic. So what I mean by that is the body of the candle, as I said before, is the acceptance area, while the wicks are the rejection areas. Support and resistance levels can be clearly seen through candle body and wick formation. My personal preference is that I use the daily RTH session bars, and of course, as I said, these levels are not precise trade locations. They're simply suggested potential support or resistance. The market may trade above or below the resistance levels before looking for rejection or providing or creating a wick. So let's take a look at what I have here. I'll just start on the bottom here when we see that we have a level that was for 2 days somewhat of a resistance area, and then the next day the market opened above this potential well, now since we were above it, we would think it would be support, but we can see that the market actually traded well through this level, but it ended up closing right on top of that. So that's what I mean by these being not precise support or resistance, but they are suggested areas that maybe going forward will be important for us to keep an eye on. So we can also see that the market, once it found that support, we can see the next day the market had a strong move higher, and then the following day we gapped up. So again, we could say that there was potentially some resistance being set up there, and then the next day, of course, we gapped above it and tested the top of that resistance for 2 days, and then just continued to auction higher here. And then what we see here is when the market finally came back to that level, it was supported there. So we know there was a gap there, of course, but it was supported there, and then we saw a good, strong reaction or bounce up out of there. And then finally we came down and tested again, and what did the candle do? It closed right on top of it. And then the next day, of course, it traded up out of there. The following day, closed right on top of it. The next day, it really just opened there and ran right to our next support area. So it just kind of helps us identify, as I said, potential support and resistance areas. If I were short going into this level here, I'd probably be looking for potential signs of exiting the trade if needed. And of course, the next day we see we opened just above it, we traded through it again, and we closed on top of it. So we can see that this was still a valid level. But then the next day, even more interesting, is that we opened right on top of our previous support area and just a strong move up out of there. And then we just kind of one-time framed higher, and we finally just kind of paused here and created somewhat of an area. So what we're seeing here or what we're looking for is the wicks of these candles and then the base of the body of the candles. So we can see that there is something setting up here. We finally are supported there. We trade higher, establish some resistance, come down, test the top, test the resistance, strong bar right down to our support level. The next bar opens right on it, just rips higher, right back to resistance. We get some pause, and then finally the market breaks right through that level. So the expectation then is that potentially the market would come and test this level one time. But when you see a market just trade right through a level like that, it could just simply mean that something has changed there, and that level is no longer a very important level to really watch. So again, these are just visual references or helpful ideas to see where maybe the market will be supported or find resistance at in our analysis, and just get a sense of, as I said, areas that we may see some sort of a reaction occur there. So there may be other reasons, confluent levels, or maybe Fibonacci or whatever else that's out there, but these levels are very clear, again, with the wicks, or what we're looking for, and the base of the bodies of these candles. So very simple stuff. We can look at it on a larger time frame as well. So here's the weekly bar chart, same concept. Here's the level of resistance. We finally break through it. We trade higher, find some more resistance, trade down, and this bar just kind of trades to it and closes above it. This one opens above it, trades through it, and then reverses through there. So again, just a suggestive area of potential support. We come back to our resistance area here, just blow right through it. We also we opened right on a previous resistance as well, and just strong move up out of there. We make a pullback, and we find support there again. So we can see that it's useful even on a larger time frame. But I personally just prefer to use the daily bars, simply because we're seeing more detail there, and the levels themselves are a lot smaller, so they can be a little more helpful in your intraday trading. But that's pretty much it as far as drawing these out. Is I'm not using fractals as potential support or resistance. It's really just these the wicks that are showing us these levels. And here's a great example right here where the market was continually closing above this level. So that's really what I'm referring to here. So again, we're not using fractal points, we're not using some sort of a mathematical equation or anything else. It's really just kind of old school candlesticking stuff that we're seeing here, is just these support and resistance levels that are very clear in the market. And that's it. Also, one of the nice features with Sierra chart is that I can actually plot these lines onto my other charts as well. So I can overlay them onto my other charts, so I know that I can watch the price action and look for confluence and things like that when we get to these areas. So for example, maybe an open here, we test that support area, maybe there was something else there as well. So obviously that would be a nice trade location based on that confluence. And that's kind of how I use these. It's just, again, nothing, there's not a science here. It's just real straightforward stuff. I'm not using wicks. I'm basing this off of the areas of excess, just like you would with market profile, areas of excess. So anyway, that's pretty much how I use it. There's really nothing else to it. Okay, so let's move forward here. Let's talk about Fibonacci levels. Again, you might be wondering, well, how are Fibonacci's fitting in with the whole auction market theory process, and looking at the markets from a larger perspective and into the smaller perspective? And I think the answer to that is actually pretty simple. It's the way I use these is I look for the market to go from one extreme to the other. Standard bell curve type of thought process. I realize that the numbers themselves are somewhat of a mathematical sequence, but I guess the visual that or the expectation of where the market rotates to is from that one extreme to the other type of thinking, rather than a very specific type of straight line. And it makes sense in that way. So let's kind of walk through this here. So Fibonacci levels, as I said, are an excellent tool in seeing the big picture support and resistance levels, but it also provides us with a bigger picture price target expectation, which I'll show you. And as I said, I look at these in the same sense as other auction market theory concepts, in that the market will test one extreme and then rotate to the other extreme in that whole bell curve like thought process. Fibonacci levels provide us with a series of measured moves, which are very helpful in identifying the potential changes in a bigger picture trend, or of course the continuation of them. And the following numbers is what I use for my Fibonacci levels. Of course, the anchor point is simply our 0 point, or our middle point, I guess you could say. Then I look at the 23.6, 38.2, 50%, which is really just half back. I know it's not really a Fibonacci number, but it's still useful to see the half back moves. I then look at the 61.8 level, the 78.6, the 100%, so that's my second anchor point, and then obviously the other extremes, so the negative 23.6, the negative 38.2, the negative 50, the negative 61.8, the negative 78.6, and the negative 100. So in that way, we're looking at the standard deviations, if that makes sense. So measured move reaction zones are typically the 50% to the 61.8% levels, with the expectation of the market rotating to that other extreme. Levels are always drawn out from left to right, low to high for upward trends and high to low for downward trends. And I'll show this in a minute. When a market does not make a full pullback or full halfback move and just takes off, we need to draw out an extension. This is usually from the previous measured moves, anchor high for upward moves and anchored low for downward moves. And lastly, just again, we're looking at larger perspective stuff, so I like to use the RTH daily bars for this. I think it provides us with the cleanest levels, and again, when we're drawing from all these fractal points and everything, it can become very subjective, and I think it's really important to not fall into that and draw Fibonacci levels that really mean nothing by using these smaller time frame charts. I think you really need to use larger time frame references in the context of looking at a top-down analysis approach. So here's an example of some measured moves that are taking place here. I've kind of shaded this this low, I've shaded the high, and here's our pullback here, and then there's our target. Here's another pullback, target, pullback, target, pullback, target. So we can see that there's measured moves occurring here, and I'll show you how these work out. So here's our significant, our key fractal low point. So we pull from the low to the high, so left to right. Here's our high, here's our low. We have a halfway back, actually to the 61.8 level there, and we see a clear reaction to that as the market takes off and runs to the other extreme. So you can say that if you were to just draw out a bell curve, you can see how it went from one side of that curve to the other. Very simple. So now let's say here's our key pullback here, so that becomes our next area that we want to anchor from for our next measured move. So we pull from the low to the high. As we saw, the market actually ran a lot further than our expected target area, so that certainly is a heads up. But we do pull from the low to the high, and we see that the market does not make a halfway back or a pullback to the 61.8 level. It just really pauses all the way at the 23.6 level. So when we see that, that really just tells us that we need to draw out an extension move. So what we did is, here was our previous low to high, here was our pullback, and that was our target. What we want to do, as I explained earlier, is pull from the previous high, or the anchor point high, to the next high. And when we do that, we see that we did have excuse me, a measured move pullback here. And from that point we went right to the other side. So target is obtained, and we continue on and do the same process over and over and over until something breaks. And then when something breaks, we just need to adjust our anchor point to the one pullback before that, and we see that it works. And if obviously that breaks, then obviously that's a clear heads up that that trend has changed. So the idea there is just to use these key fractal points and have clear expectations where price will tend to migrate to next. So same thing, the whole bell curve concept. So let's talk about what we just went through, all this information. I mean, that's a lot of information to cover, and on a daily basis, of course. And I mean, those are a lot of charts, those are a lot of you know, different filters and pieces of information that we're looking at. And I think you run the risk of, as they say, analysis paralysis. And certainly that is not the intention here. What we're trying to do is look at these important key references and bring that into one simple concept and idea of what the market is telling us, and more importantly, to not let it confuse us in any way. So let's talk about that. So to simplify everything, what I use is I've created a spreadsheet that just provides me with a quick glance at the various time frame filters, and it just immediately tells me you know, what's going on a larger time frame when I'm looking at the markets on an intraday basis. It's kind of like it keeps yourself in check, if you will, as to you know, what to expect, what's the market going to do, and you always stay on that path of least resistance. Again, this is a lot of information, so am I updating this on a daily basis? Absolutely not. That's just too much work, you know. So what I like to do is just update that on a weekly basis, say like on a Saturday or Sunday. Just, you know, update any information that may have come to light, or you know, just go through the filter process and have that all ready to go. In fact, within Sierra Charts, I do have a special template that just I can quickly click on it, and it has all my larger time frame reference charts there ready to go. So I don't have to have a whole bunch of charts open on my, you know, intraday trading charts, I guess you could say. So it's just kind of preserves space and everything. And of course, by doing this, we're just determining whether the market is balanced or imbalanced, and we're just identifying that path of least resistance. But it also helps to keep track of other key references such as support and resistance levels, as I just shown, as well as Fibonacci levels, which gives us our, you know, target expectations, but also helps us with our bracket extremes. As I had mentioned, when we're in a balanced environment, we simply don't want to be selling into support or buying into resistance. So a lot of information, and then what we do is just bring that all in together, as I said, into a simple spreadsheet, and it would look like this. So what we have here is and this is available in the download with this video, obviously. But we have it's got this is what I refer to as my market analysis report. And for this particular market, this is the S&P contract. This is obviously dated information, but this was back on October 2nd, 2013. We just look into our our table, what we have here is that we have structure, bracket high, bracket low, position within channel, EMA structure, VWAP structure, previous VWAP, market profile structure, and POLR, which is the path of least resistance. So if we look at this, we can see just on the pure bar charts alone, the market structure is imbalanced, meaning that's one time framing, but not only that, it's ripping out to higher highs. Same to be seen on the quarterly basis or quarterly bars. And then when we look at the monthly, we had some overlap occurring, as well as the weekly and daily. So we can see that just by looking at this information alone, on the shorter term, there's the potential for rotational moves. Of course, it all depends on where we're trading at, but that is a key important thing there. Is the shorter term is rotational, while the longer term obviously is still very strong to the upside. So really that just helps with our identifying the path of least resistance. We can see that we had a bracket high and low, and if the market's not trading within a current bracket, what I typically do is put the previous bracket levels in there until we establish a new one, because that's helpful in saying, well, if we have a pullback to say 1630, I will look for a rejection there. And the same rings true with all the other smaller time frame references. And then the next piece is position within the channel. I mean, if you looked at the yearly on the back adjusted contract, it's clearly a strong breakout to the upside. The quarterly, we were at the first standard deviation level, the monthly second standard deviation level, weekly first standard deviation, and then on the daily we're actually trading at the mean. So obviously that's a smaller reference there. So on the EMA structure, and I believe during this time there may have been somewhat of a pullback in the market, but on the yearly, I'm not looking at EMAs on the yearly, that's just too big. In this one I actually did look at quarterly, but typically I do not look at the quarterly or the monthly at that really. But just for the sake of this reference here, we had short-term trends, meaning that the market was trading at either the 5, 10, or 20 EMA. And then on the daily, we have a neutral, and that was most likely trading between the say the shorter term and the longer term moving averages. So just kind of a rotational type of environment there. And then when we look at the VWAP structure, as I walked through earlier, it's saying the yearly was balanced. So what does that mean? That most likely means that at that particular time the market was trading inside of the current VWAP's developing value. However, we look at the next column here, we see that the market relative to the previous VWAP value, I'm speaking in terms of value here, was imbalanced, meaning that we were trading well above our previous VWAP's value area. Quarterly was again trading within value as well as the previous. Same all the way down. However, if we look at on the weekly relative to the previous week's value area, we were trading above it. And then the daily, it's just too micro there, so I wouldn't put much or significance on that, but we were trading above it most likely there. Or I'm sorry, below that. Same with the weekly, because I'm seeing something here. Market profile structure, obviously imbalanced. As we walked through earlier, those yearly profiles, very strong breakout to the upside. Quarterly at that particular time was balanced, as well as the monthly, and then the weekly was actually that pullback that I outlined earlier there, showed that we were imbalanced to the downside. Of course, the daily we had a pullback going, so it was lower. So just zooming out again, what is our path of least resistance based on all this information? Well, we can see on the longer term we had, obviously it was to the upside. Same with the quarterly, to the upside. If we look at our monthly, we actually are at a neutral point, meaning that there's no significant side of the tape over dominating the other. And then as we got to the lower time frame, we can see on the weekly and on the daily, the path of least resistance was actually to the downside. So if we were to look at this in a bigger picture and say, well, until these larger time frame references all turn down, then these small, I guess you could say, imbalances to the downside were most likely going to be limited. So again, it helps us with our intraday trading, but it keeps us in check with what the bigger picture is telling us. So we don't want to become, in this example, overly bearish. And you could almost theoretically say that this is, instead of it being the path of least resistance being down, it was almost neutral. But we are looking on smaller time frame references here, so you know, if we're intraday trading, we really want to stick to that type of information there. And then, as I shown how we draw out our support resistance levels, at that particular time we had near support levels of 1670 and 3/4 and 1663.50s. And again, that's just based on the bar charts that I had displayed there, the price bar chart or candlesticks, and the wicks, the bodies and the wicks were providing us with these two clear levels for support. And then of course resistance, we had these two levels, 1695s and 1723.50s. So those are two price levels I was keeping a close eye on, obviously. And then going into the Fibonacci levels, all I do here is just fill in you know, the current measured moves levels. So, you know, if we pull back to 78 1/4, my expectation is that we run to, you know, this 68 3/4 area, or the 91 1/4, which is 61.8 and 50. And then at the time there was a small potential bearish measured move in place, but obviously that got blown through. But those are the levels I had there. So in summary, I mean, really all I'm doing here is all this information. It really just helps to educate us as to, you know, what this market's doing, and helping us stay on that path of least resistance, not become overly biased. And you know, as I said earlier, in this context, you know, we don't want to be overly bearish, because the bigger picture is still telling us something differently. So it keeps us in check. It keeps us in the know of what's going on, our important levels. And that's really the most important thing with what we're doing when we look at the market from this macro perspective down to the more micro perspective, is staying on the right side of the tape. This is probably the most important thing here. And obviously when we go into the trade methodology piece, we build that information, or this information, into what we're doing on an intraday basis. But I just could not stress enough how important it is to look at the market from a large perspective and bring that into a smaller perspective, because this right here tells you everything. This path of least resistance, you know, when the market's starting to sell off, people think that the market's going to crash, but we don't see any of that confirmation on the larger time frame, so we don't want to be overly bearish. So that's just really, it just keeps us in check. So anyway, that's pretty much what I have here. And as always, if you have any questions, there is a place on my the Private Banker forum that I have all this information, and of course you can feel free to ask your questions within that area. I'll also be posting an area on my blog. If you have questions for me there, that would be also an area for you to answer or pose those questions. But I hope this information was helpful for you. And of course, as I said earlier, you know, this is a lot of information, and I'm certainly not expecting you to use all these different filters or tools, but the idea here is to show you what I'm using, and for you to maybe identify a few of these things to help you with your larger picture analysis on the markets. So with that being said, thank you for watching my video, and look forward to providing more in the future. Thank you.